Wall Street's up to their usual games. Oh boy, we got a lot to get into here today in this video. We're going to talk a lot of stocks. We can call this maybe hanging out with Jeremy talking stocks in this video here today. We're going to talk about Palantir, Tesla, SoFi, all the popular stocks. We're going to talk about Apple, Meta, all these guys, and we're going to talk a little bit about valuation. We're going to look at these stocks, try to figure out if they're deals or not. nvidia, all these guys, Shopify, and we're going to try to figure out if we got some deals going on or not, right? First thing, by the way, I hope you guys enjoy this. Appreciate y'all joining me as always. Thank you for being subscribed to the channel, and thank you for smashing the thumbs up button. Appreciate y'all. So fascinating, right? Fascinating the way they're dropping this market today. Enough. It's just a lot of the big stocks, I guess you can say, right? And so if you caught my reaction channel video last night, I put out late last night, put out a video, it was very late last night, and I was telling you guys and showing you the charts of all these stocks and how they shot up to the moon within the last few minutes of trading, essentially, which, was Wall Street bonus day. It was the end of the quarter yesterday. Today's October 1st, so the third quarter is over now, right? We'll worry about the fourth quarter bonuses when it's fourth quarter bonus time. But it was fascinating to see the way they shot that market up, just blasted higher. So Apple's the worst stock of all stocks today. It is the biggest market cap out there, right? And down 3.2%, sending that one down. As far as Apple's valuation here, is Apple at a place where that valuation is compelling? We can take a peek here. So forward P, trailing 12-month P 33, forward P 31, 2-year forward P 30 on Apple. Next year, expected earnings per share growth, 8%. Could they hit that? That's definitely a possibility because we know they got big share buybacks, right? Revenue growth, 5%. It has been, I would say, a little concerning how slow iPhone has started in terms of sales cycle. It was supposed to be better than basically what it's been so far. So I don't know. Apple's kind of in no man's land. I don't really look at this stock as, I don't look at it as a ripoff, but I also don't think you're getting a great deal on Apple shares here at all, because you're not going to really be able to get major, we can call it major upward move in PE ratio now at this point in time when it comes to that stock. So you're really just counting on revenue growth and earnings per share growth with this one, right? Snowflake down big again. You want to talk about one of the most disappointing stocks in the entire stock market. Look no further than Snowflake. Year to date, this stock is down 41%. Meanwhile, its peer stock that a lot of people would always compare Snowflake to back in the day is Palantir. And let's also compare it with the Qs as well. And so here we are, Palantir stock's up 121%, right? And Palantir's business model is not exactly the same as Snowflake, but people would always compare these stocks with each other. And when Snowflake was doing good and Palantir was doing bad back in the day, this is like 2022, oh, did the Snowflake crowd love to compare it to Palantir. And boy, have the tides turned now at this point in time, right? Palantir 121% this year, Snowflake down 41%, and the Qs are up about 20%. So Snowflake's been absolutely just a complete, we can call it trash stock. I mean, absolute trash stock. Now, as far as Snowflake, none of this dropped so much. Is this one now compelling? So let's go ahead and take a peek at Snow, because this is one of those stocks people look at and they're like, is it a deal? Is it not a deal? Under a $40 billion market cap on this one now. Forward P and 2-year forward P are still insanely high, right? Still insanely high. Now, Snowflake's very early on in regards to their profitability cycle, so it's something to kind of keep in mind. But, people always say Palantir is so highly priced. Well, if we compare Snow next to Palantir, all of a sudden Palantir doesn't look that dang expensive, right? Isn't that interesting? Forward P on Palantir is 95, super high, for sure. Snowflake's 161. Palantir's 2-year forward P, 88. Snowflake, 112. So it's funny, you could look at Palantir and you say that's an expensive stock, but then you compare it versus Snowflake, and suddenly you're like, wait, maybe Palantir's not that expensive, right? We look at next year, they're turning profitable now. If we look at next year revenue growth, listen, Palantir, in my opinion, no doubt they're growing 20% plus next year, over the next year. Like, no doubt in my mind, right? Snowflake, they have at 22%. So we're in a battle now that Palantir might start outgrowing Snowflake's revenue. I think it's a pretty high probability next year that Palantir could outgrow Snowflake, which puts Snowflake in an awkward situation for their stock price because Palantir is far cheaper on a forward P basis. So if I can get better revenue growth from Palantir, the Snowflake, and the forward P is lower, and I like the business model better, then actually Palantir is actually a better direct play than Snowflake, even though Palantir stock is up massively and Snowflake stock has done absolutely horrible. So fascinating to see that. Intel down big here today. This stock down, look at this. This one's down 52% this year. By the way, before we move on, I want to just run some Snowflake projections here. And this is why it's important to run projections on stock. Because let's say, analysts are kind of thinking Snowflake 22% revenue growth. Now, generally speaking, over time, companies' revenue's the growth rate's gonna slow down. But let's just say they could grow actually 22% every year over the coming years, okay? And as far as net income growth, here's the deal. Their net income is such a mess. What do you expect them to get to? So if they grew 22% as far as the top line, that puts them at $7.1 billion of revenue come 2028, right? And that's on a market capitalization right now of about, just under $40 billion. So even if they could get to $1 or $2 billion of net income, right? If they get to $2 billion in this year, then it'd be like a 19p versus where it's at now. If they only got to 1 billion, then, we could call it like a 38 PE. And that's in 2028. So that's the thing with Snowflake is it's like, yeah, the stock's gone down so much, but it doesn't make it a great deal. And that leads to Intel, right? Intel down 52% this year. But is Intel even an interesting stock? Well, we're going to see the mess that is Intel here. Check this out. So the forward Ps look great when it comes to this one, right? But the current year expected revenue growth is 1%. The earnings per share has tanked here recently. And people expect it to get back, but we'll see. We'll see in regards to that one. Let's go ahead and take a look at the charts of Intel. Oof. Yeah. That's not what you want to see. This is where we are at very recently, like the most recent quarter for Intel. And look at this. It's just down, down, down. Now, analysts are thinking it should start to pick back up over the next year. That's definitely a possibility, right, with their new fabs coming online and whatnot. But the moral of the story is this is no fun. And then even if they do come back the way analysts are kind of expecting them to come back over here in future quarters, the issue is you're still not even close to being back to where you were just a few years ago when it comes to Intel. So it's a mess. The margins are a mess. The profitability is a mess for this company, right? This is the most recent quarter. You always thought of Intel as just a money printing machine, and that's certainly gone away. So they're getting a lot of taxpayer money. So that's, I guess, a good thing for them. But man, Intel's just a mess. Speaking about not a mess, nvidia, and obviously nvidia just incredible run, but certainly the stock's come to a grinding halt now at this point in time. And as I explained to you guys a million times, it's just people are trying to figure out what those numbers are. And when I say those numbers are, I'm not talking about this year. I'm not talking about next year. I'm talking about 2026, 2027. That's the way people think about a stock like nvidia, and that's why this stock can't go anywhere right now, because people are still concerned about what 2026 numbers are looking like. So until there's clarity and confidence around what 2026 is going to look like for NVIDIA, the stock's going to be in no man's land. And it's going to flounder between, we can call it 110, or we can call it about $100. It's going to flounder between $100 and $140. And it's going to move up, it's going to move down, 100 to 140, back. But if you could get real confidence that 2026 is going to be a banger year, as in 15, 20% plus revenue growth for NVIDIA could go at 150 easy. But you gotta get something. And I don't know if that's Jensen coming out saying 2026 demand is already starting to be filled. Like, there's got to be something there, right? MU is an interesting stock. This is a huge memory chip company. Stock's done decent this year, about 22%, but it's down significantly from where it was back here in June, 153. But that's when semiconductors were flying. That's when NVIDIA was like all-time highs, right? So when it comes to MU, if we go ahead and take a peek at this valuation, now keep in mind, MU, because kind of more of a commoditized business, they usually don't command big PE ratios. It's just the way it is. Forward P13, 2-year forward P7 on this one. Now, MU might not be a bad buy, but I got to tell you a totally different frame of mind in how you know when to buy MU and when not to buy MU. It's a very screwed up stock, okay? So here's a moral of the story in regards to MU, and always keep this in mind. Generally, the best time to buy MU stock is when they're losing money or when the P ratio looks extremely high. That usually means that they're in a bad memory chip cycle. And unfortunately, a lot of times the worst time to buy MU is when it looks really cheap and the P ratios look insanely cheap, because usually it means they just went through a very hot cycle, or they're going through a very hot cycle for memory chip demand, but then it always ends up turning the other way eventually. And so that's a way to kind of think about it, and it's kind of a screwed up way of thinking, but it actually works in regards to MU, because you look at basically every time the stock looked insanely expensive, it was actually a great deal. And every time the stock looked really cheap, it was not, essentially. So it's a screwed up situation, but it is the way it is, right? AMD 161, this is another stock that's just floundering. I mean, look at this baby. It's at the same price it was back at the beginning of January, right? Now, AMD's numbers have been, in my opinion, somewhat disappointing this year. They haven't started to really come through with the sorts of numbers you'd really want to see from AMD. It doesn't trade that rich, considering it should have very nice revenue growth and earnings per share growth over the coming years. You know, starting kind of next year, moving in forward years, that revenue growth rate of AMD should be a little bit higher than NVIDIA, which is nice. So, I think AMD's okay here. I don't love it, but I like it. I'll say that. I like it. Like, if I had to buy some shares at 161, would I be bothered by that? No. Obviously, it's not like buying it for $55 like it was back in 2022 in that crash. But that crash was so insane, 2022. We honestly should not even look at some of those prices back in 2022, because it just gives you such a false sense of like reality, in my opinion, right? Because then you could look at all these stocks and like, oh my gosh, it's so expensive, versus where it was in 2022. But that was an epic crash of catastrophic proportions for these stocks, right? Intuit's always just a great company. This is a stock that hasn't done a dang thing. It's up a whole 1% this year, but they have a great business model. If you're a small business owner, I almost guarantee you use Intuit. It trades rich, but gosh, it's just such a stable business model. Earnings per share growth should be very nice. Revenue growth, very nice for this company. It is such, and if we see Intuit here, that's funny, Intuit and Intel's ticker symbol so close to each other, right? By the way, if you're wondering why these big pops here, this is because of tax time. So you always want to look at a trailing 12-month basis for a stock like Intuit, right? And, it's been a very nice ride up for Intuit over time. So it's one of those companies, kind of like Adobe. Adobe's kind of always been one of those companies as well, that's kind of just a consistent grower. Now, there is a lot of fear around Adobe when it comes to AI, right? And what does that do for imaging? OpenAI is seen as potentially a big competitor to Adobe, so it is something to be aware of, and that's a risk factor with Adobe. And I believe Adobe's trading actually fairly cheap because of this risk. So let's take a peek at Adobe here. So yeah, Adobe's at a 25 forward P, 23 2-year forward P. Given the market conditions we're in right now, and given how stable Adobe's business model is, kind of a 10 to 15% grower a year, I could say this is actually Adobe trading relatively cheap because of the OpenAI threat and the worry around that, right? So just a little kind of, thoughts there. Microsoft, I don't talk a lot about Microsoft stock, even though it's a big, giant corporation. Microsoft's always just one of those companies to me, obviously a beast company, stable, going to put up their numbers. Don't love the valuation. I also don't hate the valuation. A 32 forward P for Microsoft. I mean, look at how stable the business model is. They're kind of one of those companies going to grow 10 to 20%, bottom line, top line, year in and year out. Recessions, no recessions, and high inflation, low inflation, doesn't really matter. And so for that reason, Microsoft's kind of one of those stocks that's almost always a buy. Stock has been decent this year. So let's go ahead and pull up Mr. Softy. It's up about 14%, which, is decent performance. But, listen, guys, that's not very good. Look at the Qs. The Qs are up 19%. So Microsoft, although it's done decent this year, it's actually underperforming the Qs, which is kind of crazy to think that, right? That leads me to Shopify. Shopify. This stock has done not a whole lot this year, right? 6% gain, underperformed the market significantly. But I got to say, I like Shopify here. I really do. I like it in the 50s and 60s better, but here I like it as well. 2-year forward P looks insanely high, 56, but here's the deal. How many companies you're ever going to find in the market that you can count on growing 20% a year in, year out? And they're going to grow their earnings per share much more rapidly than that, right? Much more rapidly. So when I look at Shopify, it's not as, how can we say it? It's not as expensive as it looks, okay? So let's say we could run, I think 22% numbers would be fair here. Now, earnings per share is going to increase much more rapidly. I think they could probably do a double up of revenue over the next many years. And so now Shopify is always going to trade rich, so you're probably going to command anywhere from a 40 PE to, I would say, about a 70 PE. So, Shopify is one of those stocks, if you're thinking, oh yeah, can I get it at a 20, 30 PE? No, no, okay. Shopify. If you do, it's because we're going through some sort of epic crash or something like that, right? And so this would only put the company at net margins of 16%, which is honestly probably too low, which means we need to likely ramp this up, because I can tell you the net margins are likely to be in at least the 20s. So let's run 55% a year on the bottom line. And the reason being is Shopify is such an asset-like business model, and they're going to reach a lot of maturity over the coming years. So that puts us more realistic here. That's about a 22 margin. I would expect for sure their net income margins to be 20% plus come 2028, right? So this is more realistic. It puts the stock somewhere between about 130 and 227, depending if you want to value it pretty dang low, which if they're growing, bottom line 50% a year and top line 20% plus, which is not crazy to imagine over the coming years, a 40 is really low for PE. But even in that situation, the CAGR is about 13%. A more realistic is probably about a 70, and you're at about a 30% CAGR there. So that's why I like Shopify here. And I mean, just those sorts of great companies. I mean, they're special. They're special, and that's definitely Shopify, because they just come out with great products and services. Oracle, this is one I'm beating myself up over a little bit, because this is a stock I wanted to buy last year. I didn't make a move. Why didn't I make a move in Oracle? It wasn't around valuation, I can tell you that. If you look at Oracle, even now after this move, Oracle's valuation is actually pretty darn compelling. Go ahead and take a peek here. Even after this move, the 2-year forward P is 24. It's nothing crazy, right? The reason I did not buy Oracle stock is one reason: the balance sheet. The balance sheet of Oracle, not good. It's not a good balance sheet on that company. So that's why I never bought Oracle stock. And obviously, it's really damn good. And that kind of hurts me. But sometimes that's going to happen, right? Sometimes that's going to happen. But in regards to shareholder equity, I mean, considering the size of the company, their shareholder equity is bad. I mean, look at the market cap of the company. Look at the shareholder equity. And remember, I was taking a peek at Oracle right back here, right? Kind of in this frame. And so I was looking at their shareholder equity. They had $2-3 billion of shareholder equity. And so I'm looking at the company. I'm like, back then the market cap was, I think, 300 billion or so, right? 300 something billion. I'm like, this company doesn't even have a 1% of their market cap in shareholder equity. It's horrible. It's trash. And so that's what kept me out of Oracle. And at the end of the day, I'd rather miss out on some gains on a stock than, we can call it, throw away my principles just for, some gains or something like that, right? Tesla, if we're talking about stocks that haven't really done much this year, Tesla's that, right? Up 4% for the year. That's nothing. Now, when it comes to Tesla, this is, obviously always a very controversial stock. We know that. But it looks very expensive. 76 forward P, 61, 2-year forward PE. But they are expected to get back on the right track in 2025, which is good. Very, very good. And Tesla's always going to trade rich. That's just the bottom line with this company, right? It's always going to trade rich. If you think I can get Tesla at a 10 PE like the other auto manufacturers, just no. So let's run some projections here with Tesla. So let's say they grow revenue about 20% a year, which I think's, I think that's in the right ballpark, right? As far as net income growth for this company, we could run a little higher. So let's say it's a 25% number for Tesla here. Okay. 25%. You got to, I mean, at the end of the day, their business is low margin. We do know that, right? And 40 to 70 is about right for PE ratios here. I mean, it doesn't give you a very attractive return on investment, right? It just doesn't. So we could run these at 50s because it is Tesla and it pretty much always commands a 50 plus PE, and that probably won't change. As long as Elon Musk is leading the company, it probably won't change. It'll probably always command a 50 plus PE, right? So if you put in that 50 to 70 PE, I mean, you're basically flat. You're getting no CAGR, no compounding annual growth rate, outrunning those numbers, right? So basically, Tesla has to grow their top line and their bottom line much more substantially over the coming years, right? So you either need this company growing revenues at like a 30% plus clip, or you need them to just go crazy with their net income. And let's say grow net income at 35% a year. If they can grow net income at 35% a year, then we can at least start to get somewhat in an interesting area, right? Because if they grow net income 35% a year, that puts them at net income margins of about 11%, which would be pretty dang high for Tesla if they can get to net margins of 11% plus, right? But that gives you a compounding annual growth rate on the low end of about 8%, compounding annual growth rate on the high end of about 18% here for Tesla. So you can see how the stock could still do well over the coming years, but they've got to come back with the big growth. The big growth day for Tesla, it has to be back in full swing. If you're going to be back in full swing, we're going to have a lot of fun in the stock. But if the company grows less than 20% a year, Tesla's not going to do anything for years still, which is going to be very disappointing because Tesla stock already hasn't done anything for years. Like, this stock's obviously significantly lower than what it was many, many years ago, right? Like, this stock's lower than it was, it's almost 4 years ago now, right? We can go back to January 2021. I mean, this is only 4 months from now. The stock's down 11% from there, right? So that would be really, really disappointing. So when it comes to Tesla, you got to get back to like 30% plus growth numbers. If we could do that, Tesla's going to be a lot of fun again. We don't do that, it's going to flounder. So what are my levels of confidence that Tesla can get back to 30% plus growth? So I would say I got to see what I got to see what happens 10/10. October 10th is going to be a huge day. If I walk away from that day convinced they have a model in the market that's going to be the mass market vehicle around the world, I think Tesla can easily get back to even 30% plus revenue growth a year. But they've got to have a model under $30,000 that is just going to be a banger. And when I say under $30,000, you got to keep in mind what I'm talking about here. I'm not talking about with tax credits. I'm not talking about if you factor in, the electric savings versus gas. No, I'm talking about straight up, out the door, under $30,000. No, I need a tax credit to get it under 30. No, none of that BS. Straight up, under 30,000, out the door, and I'm convinced that model could take off around the world. Like, oh my gosh, game changer for Tesla forever, right? That's the real iPhone moment for the company. But we got to do that. And so if I walk away convinced after October 10th, yeah, it's going to happen. If I don't, then I can tell you, it's not going to be. We'll still be in a flounder mode for Tesla for years. And when I say flounder mode, I mean that just means the stock goes to anywhere from 150 to 300 and back and back and back and back. 150, 300, and it's just flounders there for years and years and years. And then it ends up being a lost decade for Tesla. And which means essentially, when I say a lost decade for Tesla, that means the stock doesn't go anywhere from like 2021 all the way to like 2030. And so it's a complete lost decade there, right? So that's my opinion on that. But we'll see. Meta stock doing tremendous today. Very, very happy camper with Meta. I mean, just an extreme performer. I mean, what a time. This is my biggest investment, and it just does tremendous. And the best thing about Meta, right? It'd be one thing, I'd feel very differently if I was holding Meta and it was just like the valuation was going up in terms of the P ratios and it was getting crazy, right? It was trading at some super high P's like Tesla. That'd be one thing. It wouldn't make me feel uncomfortable, but it still is such a cheap stock. And that's why I think this stock could climb to 1,000. Because I'm looking here and why I've kept telling you guys I think it could maybe go 700 before the end of this year because of the forward P's. Look at the forward P, 25. And keep in mind, Meta beats these numbers very often. So, whatever analysts are expecting for earnings per share, it might end up being too low. 2-year forward P, 23 on this stock. And, it's one of those companies you can count on growing 10 to 15% top line, bottom line for years and years and years to go. So when I look at Meta, it is still a cheap stock, borderline dirt cheap stock, right? Let's run some projections here on Meta. It would be great if the company could grow 20% a year, by the way. Look at that. I mean, if they could do that, oh my gosh, that'd be insane. But I'm not counting on that, right? I think the more realistic growth rate for Meta might be 14% on the top line here for Meta, right? And I think bottom line for Meta, more realistic, I think they could probably grow at about a 20% clip. Which if they do that, net income margins push to around 40% over the coming years, right? 50 to 70, no. Meta's not going to command that because, I don't know, maybe they will eventually someday, but I don't know. Wall Street always has disrespected this stock. So I'm going to run them at kind of a 25 PE to 35 PE, which I think is pretty dang fair for Meta. If you can grow your top line 14% on average and you're growing your bottom line around 20%, and you've got the sort of margins Tesla has, that Meta has, like 25 to 35 is about right. That would put the stock in 2028 somewhere between about $1,100 and $1,500, and compounding annual growth rate on the low end about 17%, on the high end about 28%. And the best thing with Meta is it's not like taking a huge risk. It's not like this is some risky company, right? It's like their user base is extremely sticky. They come back, they keep using Facebook, they keep using Instagram, they keep using WhatsApp, right? The wearables business continues to obviously go up and up and up. The numbers are great in this company. The shareholder equity, oh my gosh, look at the shareholder equity. It's booming for the company, right? And so everything across the board is just phenomenal with Meta, and that's why Meta could continue to be a performer regardless of what happens with these other stocks and Apple and all these other guys. And that's why it's really a creme de la creme stock, as I call it. It's beautiful. And man, I love being a holder of Meta. I love being a holder of Meta. Oh gosh. Now, Wynn continues to show strength here. And, that's actually my best stock here today. Literally, my best stock is Wynn Resorts. That stock is on fire recently. Check this out. Check out a 1 month on Wynn stock. Wynn stock is up 28% in the past month. Past 5 days, past 5 trading days, Wynn stock is up 19%. This stock is an extreme performer. And I mean, you could really see it on a 3-month chart. Like, look at that move. Oh my gosh. What a move. What a move indeed. So when it comes to Wynn stock, and I spoke about this one. I don't know if you guys got to see 5 stocks I'm buying October 2024 edition. If you didn't get to see that video, definitely check out that video, right? I got the pumpkins in the thumbnail for it. But Wynn was one of the 5 stocks featured in that video, right? And I spoke extensively about Wynn Resorts, but this one's just extremely attractive. And as I was explaining in that video, Wynn is way more profitable than it seems. And even if you take into account their numbers, it still is a very, very cheap stock. But the thing with Wynn Resorts is, they run so much depreciation each year. Like they've done around $700 million of depreciation and amortization in roughly the past year, the past trailing 12 months, essentially. The number is a crazy number. And as I was explaining in that video, the unbelievable thing with Wynn properties is the reality, in my opinion, they don't actually depreciate. My opinion is Wynn Resorts is more valuable today, and I'm talking about the Las Vegas properties, it's more valuable today than it was 10 years ago. It's more valuable today than it was 15 years ago. More valuable. Why? Well, because they upkeep those properties so phenomenal, they keep them looking so great that it's almost like a plug and play. Like, let's say hypothetically they sold it to somebody else. I think somebody else would be willing to pay way more money than what Wynn actually spent in the building, and that's rare. That never happens. That's extremely rare. Because usually, if somebody builds a hotel or resort or something, over time, they kind of let it go, and it just kind of actually really depreciates. And eventually somebody's like, we just got to knock this thing down and build something new on the land, right? And so the land becomes what's only valuable. With Wynn, the land becomes more valuable. I tell you that Las Vegas strip land they're on, because the North End's been building out, and it's going to continue to build out. That land that Wynn's on is way more valuable today than it was 10 years ago. Way more valuable today than it was 15 years ago, and it's not even close. So the land the property sits on is way more valuable. Same thing with Macau, by the way. But then additionally, the actual buildings, You know how much it would cost to build those same buildings nowadays? As classy as that is? Oh my gosh. Crazy numbers. Construction costs has gone through the roof the past 10, 15 years. It's not even, I don't even think for Wynn's budget they had back then, you couldn't even build a fraction of those resorts nowadays. No way, dream on. And so Wynn stock is way cheaper than it looks. And so even though that stock's been beasting, it's still a steal deal. It's still a steal deal. And once again, I spoke about that stock extensively on 5 Stocks I'm Buying, October 2024 edition here on the channel. So if you didn't get to already see that video, definitely check out that. Cheesecake, you know my opinions there, very cheap. Nike's reporting after the bell, which is going to be very, very, very exciting. Very exciting for when it comes to that. What do I want Nike to do after the bell? Do I want Nike stock to go up? Do I want it to go down? I'm actually kind of indifferent. I'm okay with whatever. If Nike stock's up 5, 10% after hours, or if it's down 5 or 10% after hours, I'm kind of indifferent. If it's down, that's fine with me. I'm going to buy more shares. Like Nike, anything under 100 is a deal. So like send it down, that's fine. I'll buy more shares. If it goes up, I don't really have a problem with it. And the reason being is my position for Nike is pretty close to being fully built. You know, I would love to add a few more shares, but it's not like if this happened 3 months ago or 6 months ago, it would feel very different because I was still building out. But I bought so much Nike stock here recently that if it was to go up, it has my blessing. It has my blessing. I'm okay. Like whatever, right? Celsius. I love Celsius. That baby's. I really want it to go 25. I have visions of Celsius at 25. Oh yes, I do. But the stock's already a deal. Let me make very clear about that. 31, it's still a deal. My hope is they have some sort of kitchen sink quarter coming out with some bad guidance, freaks everybody out bad. There's another major sell-off of the stock and it goes 25. 25, 22, something like that. Yes, please. I have visions. I have a dream that one day Celsius can be $22 a share, $25 a share. But I don't know. Wait, did I just delete a stock on accident? Oh no, I just deleted Wynn stock. Hold your horses. That could have been tragic. Come on, Winnie. Winnie the Pooh, get back up here. There we go. So yeah, that one's a deal. Amazon. I mean, you know, this stock, very, very attractive. If somebody's looking to build a core position or portfolio and you're looking for something outside of Meta, Amazon's your stock. 100%. Amazon is your stock, right? Revenue growth, current year expected 12%, next year around 13%. Current year expected earnings per share growth 61%, 18% earnings per share growth. If we look on a 2-year stack basis, earnings per share growth around 90% expected here. On a revenue 2-year stack, 26% plus, right? PEG ratio, price to earnings growth, about 2.9 on the stock right now. And so I actually like Amazon a lot here. A lot. Like I said, if you don't want to build a core position in Meta, I think Amazon's your stock. I truly do. And when I say core position, I'm talking about like the type of position you build as a big position, and then you build your other things around it, right? Your appetizers around it, your other side dishes. So let's run Amazon at about 12% revenue growth a year, which is actually kind of sleepy for Amazon based upon their historical norms. And the earnings per share growth should increase quite substantially versus, honestly, I think they could probably do like a 22% number bottom line over the coming years. And then Amazon always is going to trade rich. So you probably, lowest case scenario, get it for about a 30 PE, but that's really low. That's really, really low. I don't even know if you'll get that, right? And on the higher end, you know, you're probably looking at around, I would say around a 50 PE ratio. And even that's actually pretty low for Amazon. Look at Amazon over its history. These are actually really low PEs, 30 in the 50 range. But you run those sorts of numbers and you get a compounding annual growth rate on the low end of about 14%, on the high end 29%. And it's such an easy stock to own. Great balance sheet on the company. The revenue of the company just goes up and it goes up and it goes up. And even in recessions, even in inflation, deflation, blah, blah, blah. It's really, I mean, look at that. Is that not a thing of beauty? Is that not a thing of beauty? It's just going to keep going up. It's just going to keep going up. They have a lot of margin expansion over the coming years. They have a lot of margin expansion. Don't be surprised if those gross margins or net margins continue to increase year after year after year for the next decade, really, honestly, right? As far as earnings per share growth goes, look at this. This is where we're at recently. The earnings per share has taken off like a rocket ship. It's a rocket ship ride. And the shareholder equity also taken off like a rocket ship. It's absolutely beautiful. Amazon is, if somebody's looking to build a core position, Amazon is your stock. Now, as far as the stocks this year, it's up about 24%, so it's outperforming the market, but honestly, I think it should be up a lot more. There's no reason Amazon shouldn't have a 200 in front of it right now. That stock should easily be 220, 250 in my opinion. So that one continues to be a deal. Palantir. So Palantir, I'm going to probably do a full dedicated video to Palantir because I think it deserves it. I think honestly Palantir deserves a full dedicated video on either this channel, the main channel, or my reaction channel. Really diving into the valuation on Palantir because there's a lot of debate on if Palantir is a rip-off right now because of the insane move in the stock price, and you look at the PE ratio and you're like, oh my gosh. And so I think that's fair, right? And so I need to honestly, it deserves to go like really in depth, nitty gritty. Zoom stock. You want a good stock that I think is going to outperform the S&P 500 significantly over the coming years? It's actually Zoom. I like Zoom a lot. I would love to build even a position in the public account in regards to Zoom. I would love to. I don't have it yet. I have it in the Patreon portfolio, right? Which if you're looking to apply to join a private group or the Patreon, by the way, those are in the description area of this video. But I really like Zoom stock. It's not the most exciting stock in the world, but it's actually a really sticky business model nowadays. And so I think people are kind of, my opinion is they're going to miss out on this one. And I actually think it's pretty fairly easy money over the next 5 years. This is looking on a trailing 12-month basis. Obviously, they had the insane growth from Rona, and then they had a flat line for a few years, which is understandable. You came off ridiculous growth rates. Like, that was unsustainable, right? Everybody and their grandma had signed up for Zoom at that particular time. Their earnings per share is back on the right trajectory. The shareholder equity of this company is ridiculous. Look at this. $8.5 billion of shareholder equity. It continues to increase on a $20 billion-ish market cap. Zoom's a deal, man. Zoom's absolutely a dang deal. I like that stock. I like that stock a lot, right? And then we got some of the spec positions, which are actually doing the worst, like the more riskier stocks, which I don't look at Revolve as a risky stock, by the way. I definitely don't want to put that one in that category. But you look at like Avant, Elf's actually really attractive here. You look at like SoFi, $7, right? That one's getting hit hard. So a lot of the more speculative stocks are getting hit the worst today. And my best performers are actually kind of the least speculative. Wynn Resorts, Profit Machine, Cheesecake Factory, a money printer. Nike stocks, you know, even though they're doing bad right now, it's still a money printer in cheesecake. I want a piece of cheesecake, I think. Meta continues to perform tremendous. So, alrighty, guys, I hope you enjoyed today's video discussing everything going on here in the market. This was just kind of a little beast video. I posted this inside the private group Discord chat earlier. Like, I'm down like 2K today, and I was like, I'll gladly take that. On a day like today, with what's going on in big tech out there, I'm like, I am very happy camper being down only 2K. Very happy camper, because when you just look at the big tech kind of Red Dead Redemption out there, I'm like, yeah, I'll take being down 2K in the public account, 0.1% or whatever insane. Like, I'm a happy camper in regards to that. All right, guys, appreciate you joining me. Thanks for being here. If you're looking to join my private stock group, if you're looking to get in my Patreon and see the stocks I'm buying and selling each week, anything like that, description area down there. Much love and have a great day.